Good afternoon and welcome to Farm Focus for Monday, January 7th. Grain prices finished today's session higher, mostly on short covering ahead of Friday's USDA government reports and also correcting some extremely oversold technical indicators on the charts. March corn finished a nickel higher at 6.86. New crop December corn was up 3 cents at 7. New crop December corn was up 3 cents at 5.75. March soybeans up 21 cents at 13.89. New crop November beans up 8 cents at 12.85. Kansas City March wheat up 3 cents at 8.08, with Minneapolis March wheat finishing a nickel higher at 8.46. Outside markets were relatively quiet today. I would say if we added them all up, maybe just a little bit supported, but no big movers. Crude oil currently 15 cents a barrel higher at 93.24. Ethanol up 2 cents per gallon at $2.21. The gold market down $1 per ounce at 16.48. The U.S. dollar index down 25 points at 80.37. And the stock market currently 49 points lower, with the Dow trading at 13,386. Livestock markets were very quiet today and mixed, with February cattle up 3 cents at 132.98. March feeder cattle down 5 cents at 156.28. And February hogs up 23 cents at 86.45. News items in the markets today. Grain prices did bounce in today's session. Short covering ahead of Friday's USDA reports was noted as a significant factor today. Also, the technical indicators are very oversold, as we mentioned just a moment ago, and that also supported today's bounce in the grain markets. Prices have moved lower through December and into January as the market is removing and has been removing some risk premium. South American weather has remained mostly favorable early in the season before their crop gets in the ground. There's a little bit of a risk premium that's built into prices, and as the weather stays favorable and their crops look good, the market gradually removes some of that risk premium. Now, South America can still experience some stressful weather going forward, but it's getting awfully late in the crop year for any major weather event to affect crops. Weekly export inspections came out this morning, and they're okay for soybeans and wheat. Nothing to write home about, but at least reaching the average trade guess, while corn export inspections remain very disappointing. We take a look at a chart showing the weekly corn export inspections. Very disappointing number, just 7 million bushels exported here in the most recent week. That is the lowest total of the year so far since the crop year began on September 1st. So very disappointing number. Now, we weren't expecting big numbers, but this was even lower than the market was looking for, and it's less than a third of the 25 million bushels that's needed to be exported weekly to reach USDA's annual forecast. Turning to the soybean export inspections, a pretty good number, very close to 40 million bushels exported in the most recent week. That's well above last year's total seen in the purple line, and well above, over double the amount needed weekly to reach USDA's annual forecast. We'll need to export 15 million bushels per week of soybeans to reach USDA's forecast. So a number close to 40 million bushels, definitely a very solid number. Also want to point out on this chart, if you look at the amount that's needed, again, that's shown in the black line. That is declining on a regular basis. If this line continues at the trend it's at, by the time we get into the month of April, we could literally reach USDA's target. Turning to wheat inspections, bounce from last week's very disappointing inspections, but keep in mind that last week's numbers were during the holiday week, which often we see a significant reduction. So they bounced back to some degree up to 13.3 million bushels this week, but unfortunately it's still well below the 23 million bushels that's needed weekly to reach USDA's annual forecast. The disappointing exports over the last month could mean that USDA will lower again its export forecast for U.S. wheat, given the disappointing performance here over the last 30 days. We mentioned just a moment ago that South American weather is mostly favorable and their crops are progressing pretty well. There are some minor problems with the crops. There are some dry areas in northeastern Brazil. There's even some dry areas in the western portions of Argentina. There's also some areas that are a little bit too wet, parts of eastern and northeastern Argentina, as well as extremely southern portions of Brazil are too wet. But overall, when we add it all up together, South America is still having a pretty darn good year as far as weather for corn and bean production. Now, that's good news from an end user standpoint, as South American production, without a doubt, is going to definitely be needed by the world marketplace going into this spring and summer. At this time, as we mentioned, South America appears to be on a path toward record corn and soybean production this year due to increased acres. This is good news for the world grain buyers. The world will definitely rely on South American grain supplies this spring and summer to get by until next summer's U.S. crops are harvested. Here in the United States, corn and bean stocks will remain very tight through the spring and the summer until we get to our next crop. World demand must be switched to South American origins as soon as possible to prevent shortages here in the United States. In fact, the United States could very easily import near record amounts of both corn and soybeans this year to prevent major shortages this summer, especially if our demand remains relatively strong, especially with the lower prices that we've seen recently, which could encourage better demand. That better demand here domestically may require a large amount of imported corn and soybeans from South America as we get into the late spring into the summer timeframe to prevent those shortages here in the U.S. And as far as wheat production is concerned, we're still watching the drought conditions in the U.S. plains, as U.S. crop could be reduced by drought if we don't get a much improved weather pattern and better rainfall as we enter the spring season when the wheat begins to come out of dormancy. I want to take a look at a couple of maps that show the severity of the U.S. drought in the plains. Let's begin by taking a look at the U.S. Drought Monitor. The first map on the left is the Drought Monitor as of January 3rd a year ago. January 3rd of 2012. And in this map shows that the severe drought, those are the dark red, red, and orange categories, not the tan or the yellow, but the darkest shades. The severe drought accounted for 19% of the U.S. land area last year at this time. Turning to this year's U.S. Drought Monitor as of January 1st, severe drought accounted for 42% of the U.S. landmass. And so as you can see, the area affected by severe drought or worse, well over double the level last year, and more importantly might be the location of some of those drought areas. The Plains State and the Western Corn Belt really seeing the effects of the drought conditions compared to a year ago. Next, I want to focus on a couple of specific areas within the United States. Let's start with the High Plains Drought Monitor. And as you can see, the states included in the High Plains analysis, last year, severe drought or worse accounted for 6% of the land area within the High Plains area. This year, you can see the drought on the right, much more severe. In fact, 86% of the land area in the High Plains being affected by severe drought or worse. Turning to the Midwest Drought Monitor, which encompasses a larger portion of the actual U.S. corn and bean belt, last year on January 3rd, 7% of the land area in the Midwest was under a severe drought or worse. This year, over 30% is under severe drought or worse. So about 4 times more of the corn and bean belt is under severe drought versus a year ago. These are areas that we'll want to continue to monitor that could have a significant effect on not only production but potentially grain prices as we move into the later spring and early summer timeframe. Now, there's plenty of time for the weather pattern to change and to see soil moisture improve in many of these areas, but we do need to recognize that there are severe drought conditions in much of the U.S., including the Plains states, as well as a good portion of the western and northwestern Corn Belt. Let's take a look at today's March corn chart. And one thing that's very evident on this chart is that we have been in a downtrend since the highs were posted last summer. Last night in the overnight trade, corn prices slipped down to $6.78, which was a new low for the move. We closed day at $6.85, so we did advance about 7 cents off of the overnight low and actually closed higher on the day. Technical indicators are very oversold, but there's no sign that they're turning yet. But many times when the technicals are this oversold and stay there for a little while, you can recapture as much as a week or two's amount of losses in a very short time frame. Right now, if the market would begin to bounce, overhead resistance comes into play somewhere in the low $7 range. Turning to our March soybean chart, soybeans found support at $13.56 both Friday and then again overnight last night. Those are the lows that were posted in mid-November. So we have a double bottom on the charts at this point. From those $13.56 lows, the market did rebound sharply. In fact, today's close at $13.88 is 32 cents above the overnight low in the soybean market. This move today in soybean prices is enough to at least hook the technical indicators. Now, they're still oversold and haven't made a substantial turn yet. But if we could get a little bit of follow through in the next day or two, we could see a turn in the technicals as well. So right now it looks like significant chart support in the March soybeans at $13.56, with overhead resistance initially coming in the 720 to 730 type price range, where we've got a couple of our moving averages coming into play, and then more significant overhead resistance in the 1450 to 1475 range. Turning to our Kansas City March wheat chart, wheat prices are in a steep downtrend. In fact, wheat has given up about $1.50 in just the last 30 days. But like corn and beans, technical indicators are extremely oversold, so it wouldn't take much in the way of a friendly news item in order to allow wheat prices to bounce. We currently have chart support at the 786 level. Those are the highs posted in our sideways range from last spring and early summer. And so 786 right now, about 20 cents from where we closed today, with overhead resistance, quite a bit of open room above the market for a rally into that 850 type price range. This is Dan Kauger for Heartland Farm Partners. Thanks for joining us and have a good afternoon.